We
And
both moved our chairs.
We both did, didn't we?
We both moved our chairs.
That's okay. All right, we get in.
Yep,
we get
we're
in it
good.
now. Hi, this is Leslie with Realty One Group Inclusion, and I am here with Jessica Ochoa with Fairway Independent Mortgage, and we are talking about some topics that some buyers may not know about today. So we're going to go over a rate buy down versus closing cost, and then we're also going to go over a FHA 203K loan, something you may not know about. So Jess, we're going to start right into it and
Let's do it.
just start asking questions. So a lot of buyers have questions about interest rates and what a rate buy down is and how that can benefit them in the home buying process and what that looks like. So can you kind of tell us a little bit about what a rate buy down is?
Yep. So you've got two different types of buy downs specifically. You have a permanent rate buy down and you have a temporary rate buy down, which is kind of the hot topic these days.
Mm-hmm.
A permanent rate buy down is going to be points. So you buy points down to lower your interest rate for the whole term of your loan.
Mm-hmm.
In a lot of cases, you pay 1% of the loan amount to buy down a specific portion of your interest rate. Sometimes it's 0.5%, just kind of depends on each different scenario,
Mm-hmm.
but it does affect the whole term of the loan.
Okay.
So your second option is a temporary buy down, and that's what's being advertised a lot these days. And you have a few different options under that. Basically what it's going to do is do a permanent buy down per year.
Okay.
For each year of the loan. So you could do it for 3 years, for 2 years, or for 1 year.
Okay.
A 3-year would buy down the interest rate 3%, 3% for the first year. So just for example, if you had a 6% fixed rate, for the first year it would be 3%, for the second year it would be 4%. For the third year, it would be 5%, and then fixed 6% for the whole rest of the 27 years that you have left.
Okay. Oh, wow. Okay. So in terms of how that looks on paper, when we're looking at numbers, let's say a house is $325,000. How much would that save a buyer per year as a breakdown?
Yep. So 325, let's just say sales price is 325, we're going VA.
Mm-hmm.
So the loan amount is also going to be 325. So general rates, you're going to be somewhere around 6.25 right now. Different for everybody, obviously,
Sure.
but 6.25 average. So if we did a 2-1 buy down, let's just say that. So 6.25 is going to be your full 30 years, except for the first year would be 4.25, second year would be 5.25. Whole remaining rest of the term is 6.25.
Mm-hmm.
So that first year, it's going to save you a little over $400 a month just in interest savings.
Wow. Okay, that's huge.
Each month for the first year. For the second year, it saves you about a little over $200 a month each month for that second year. So you're saving $400 a month the first year, $200 a month for the second year, and then you're right back to your regular fixed rate after that. Nothing to do on your side.
Okay. That's great. That's actually a huge savings for a lot of people. If you look at it in terms of rental versus purchasing right now, if you're paying $2,500 in rent, but you can save $500 a month or $400 a month, that's a huge savings to a buyer for the next year, and that gives them time to figure that out.
Yeah.
So that leads me into my next question for Jessica is, what happens to that money that you got to put in escrow if you decide to refinance while you're in a rate buy down?
So that money is your money. It's an escrow account, just like it would be for taxes and insurance.
Mm-hmm.
So whatever that cost is up front, which a lot of times right now we're getting that paid by sellers.
Mm-hmm.
So your seller's going to take that money. Let's say it's $7,500 is the cost of that. It's going to be somewhere around that for that scenario we just talked about.
Mm-hmm.
So that $7,500 goes into an escrow account. We pull the monthly savings out of that escrow each month.
Mm-hmm.
If you decide that you want to refinance and there's still money left in that escrow that hasn't been used towards that rate buy down, you get that money.
Okay.
You usually don't get it as cash. You usually get it as a reduction on the principal amount that you have due on that loan.
Okay, which is good to know when you're refinancing a house, because a lot of times people start back at a 30-year mortgage the first year that they do refinance, and so that money can go towards that money that you saved, and so it looks like you really only paid 29 years instead of 30 years again for the next year.
Exactly.
So that's actually a really cool, a cool little note that a lot of people don't know about with that money.
Yeah.
So, you know, in terms of rate buy down versus getting seller closing costs paid, what would be a scenario that look like for a buyer when they're thinking about buying a home and they need a certain amount of cash to close, but they're also thinking about long term in terms of their payments per month? Who would benefit from the rate buy down versus who would not benefit from that?
So if your seller is given a certain amount of money, we can use that towards either the buy down, closing costs, however that's going to go. So really what we're going to need to know for the buyer is how much money do they have to contribute. Can they pay for their closing costs on their own? Is the seller going to still pay for some of the closing costs along with the buy down? So we take each scenario and kind of review it for the buyer to see which is going to be the best scenario for them. If you're a buyer that's thinking a temporary buy down may be a good option for you, could be somebody who maybe they expect increases in their income over the next year or two, which is the case for a lot of people. Or maybe they're gonna have other money they'll be able to contribute. Maybe you have a spouse getting out of school or something that will have more money, so that kind of eases them into that payment for that permanent buy down. Again, who uses it and who doesn't, it really just depends specifically on each borrower's application. If you use your seller concessions toward a buy down, then you do still need to cover your closing costs.
Okay.
So they're two separate things, buy down and closing costs.
Right. And that's important to know too. So when you do close on a home, you still do have closing costs. And you still have to come out of pocket for something if the seller doesn't pay for that. So that's very important to know. If the seller is doing a rate buy down, you still have those other fees that you will have to be contributing at the closing table. So awesome. That's a big thing that a lot of people don't realize, what the difference is between a rate buy down, permanent versus temporary, and also what that means for you in the long term and where that money goes if you do utilize that rate buy down. So that's awesome. The next thing we're going to run into is a FHA 203K loan. So a lot of people, it's a mouthful, and it's also very important, especially when you're buying a resale home or a home that needs some renovations, and you definitely want to hear this out. So we're going to dive right into this as well. Jessica, tell us just first and foremost, what an FHA 203K loan is.
So FHA is just a government-backed loan, so it's got the government security behind it. A 203K specifically is going to be a renovation type loan. So it gives you extra money for renovations, depending on contractors and bids and things like that. You can use it at the time of a purchase, and you can use it on a home that you already own and you just want to refinance and do some improvements too.
That's a great option. I did not know that was even possible. So there you go. You learn something new every day. I do know a little bit about these 203K loans, but they are definitely confusing and can definitely make your head spin a little bit if you don't understand it fully and what that means. So tell us a little bit about the two different types of FHA 203K options.
So there's this.
Sorry, thought it was my phone ringing.
So there's a standard 203K, and then there's a limited 203K, which gives you a little bit of limits to it, but it is also easier process. So the limited, you can go up to $75,000 worth of repairs. They can't necessarily be structural repairs. So if you're adding rooms on, taking rooms off, something like that to where it's affecting the structure of the home, then we would have to go for the standard. But on the limited, it reduces some of the inspections, some of the people that you have to have in and involved with it. The standard the limit's a lot higher on that, and you do have a little bit more of an oversight on that product.
Okay. And so with the limited 203K, we're talking like roofs and maybe an HVAC system or maybe some flooring, things that maybe want to upgrade in the house. And if the price is right on the home and there is enough equity in the house to be able to support this type of loan, it's really important to know that you can finance these things and you don't have to come out of pocket for it. And you can still have a beautiful home at the end and get exactly what you're looking for. So that's humongous in the grand scheme of, well, I really like this house, but it needs a lot of renovations or upgrades that maybe the seller hasn't done yet, but they're offering at a good price. So that's really important. It does have to appraise.
Yeah,
obviously.
It does have to appraise, yeah. You have
But
to have licensed contractors involved.
Right.
You've got to get bids and things like that that are kind of involved in the process.
sure.
But it's on the borrower side, it's pretty easy. It's and as long as we've got we've got good contractors that we can put you in with, and that we can make sure you've got somebody reputable that's going to do the work for you and get the inspections and things. It's important to get all of that up front because you need to know what your costs are going to be for that. But on a borrower side, let's just say you've got a borrower who's approved for a sales price of 300. Just do easy numbers here.
Sure.
And they find a house that's listed at 200, but it has some repairs and things that they want done to it. They technically have that extra 100 that they can use towards repairs. So they have to get bids, they have to get all those things in, the numbers have to equal out, but they don't have to find a house that's at 300 price.
Right.
They can do 200 and do $100,000 worth of renovations to it.
That's
So
incredible.
really
That's really incredible. And with the standard FHA 203K, if there's a cool rehab project, I have one listed right now that somebody comes across, this could be a huge game changer for that.
Huge.
Knowing that there are certain properties out there that need a ton of renovations, and it's structural and it's definitely more cosmetic and things like that.
Yeah.
That loan it can change the world for some people, because if you have a family, let's say there's a 4-bedroom house that needs a ton of repairs, but they have the approval for it, but they don't have the cash on hand. That's a major thing that could benefit a family that really would like a good property, that they don't have to do the work themselves, and they can finance everything that they need and still enjoy a beautiful home at the end of it. That's pretty significant. So
yeah, it can be a big deal. Down payments for those are the same as FHA standard, so 3.5% down payment, but it's on the total loan amount. So in that scenario,
Sure.
would be 3.5% based on the $300,000 price. So
Sure.
you don't have to come out of pocket with the extra 100. You just have your basic down payment.
Right.
And in a situation like that where the borrower may not be able to live in the home while these major repairs are going on, you can actually postpone your mortgage payments for up to 12 months. You have 12 months to get it done. You can postpone your payments and put them in, structured into the loan to where you actually don't have to come out of pocket for that extra payment while you can't live there too.
So how does that look? Basically, do they just take those payments and reduce the amount of reduce the amount of construction costs?
Exactly.
Okay. So that's huge too.
Yeah.
And I'm assuming that the mortgage company continues to pay the taxes and the insurance and all that, like any normal loan.
Right.
But they just don't have to come out of pocket for it.
Exactly.
And they can still live in a rental.
Until you're
prepared to finish, which and it becomes
inspections
livable.
are done, everything's set to go, then you can move back in and start making your payments.
That's amazing.
Yeah.
Like, I don't think enough people take advantage of this. It does seem a little confusing, and Jess definitely has a lot of knowledge on it, and she is definitely able to walk you through that process. We have contractors that are readily available, and we can make magic happen if you're just willing to be a little bit creative and really dive deep into it. So
yeah.
That's amazing.
Yeah.
I really love that. So Jess, why don't you tell everybody how to get in touch with you, because that's going to be important. And she would love the business, and she would love to help somebody out and really just get things moving along for you.
Yeah. So my cell number is the easiest way to call. It's 254-216-2349. We're right here in Richmond Hill. You can pop in my office. Give me a heads up first.
You can text her.
Text me. You can text me on that number. You can visit my website and check out all my reviews and everything also. And that is jessicaloansfairway.com.
Awesome. And if you haven't heard of me before, or if you don't have my cell phone number, I'm Leslie with Realty One Group Inclusion. My phone number is 912-321-2758. You can text me or call me. I'm just a phone call away. So if you have any questions about this, please reach out to me, reach out to Jessica, and let's make magic happen. And we hope you guys have a great day. Thanks, Jess.
All right. Thanks for having me.
You're welcome.